Greetings, I'm Shaun Pruitt, Zacks equity strategist, and today I'm going to be discussing if Nvidia is the most capital efficient stock to invest in. So Nvidia's aggressive expansion in AI infrastructure, data centers, and advanced semiconductor manufacturing is a reason that investors and analysts will want to watch its capital efficiency metrics more closely. And to that point, Nvidia's CapEx has soared over 500% in the last 5 years to nearly $6 billion on a trailing 12-month basis. And when CapEx grows significantly, capital efficiency metrics are more closely monitored, not because rising capex is inherently bad, but because the stakes get higher. However, in the process, NVIDIA has provided some of the most state-of-the-art technology, such as its next-generation AI computing platforms, Blackwell and Vera Rubin. And Blackwell and Vera Rubin have provided strong evidence that NVIDIA's capital investments are paying off, illustrating how the chip giant spending strategy is designed to translate directly into higher returns on invested capital, or ROIC, stronger competitive moats, and sustained cash generation. And there you can see NVIDIA's capex ballooning over the last few years to $6 billion. So NVIDIA's return on invested capital has been extraordinary, and arguably the most critical efficiency metric. ROIC measures how effectively a company turns the money it has invested in its business into profits, and it's one of the cleanest ways to understand the quality of a business. And NVIDIA's ROIC shows why it's a high caliber company with a superior business model. And ROIC matters because it cuts through the noise and tells you something almost no other metric can: how good a company is at turning its investments into real economic value. So when you boil it all down, ROIC is the closest thing finance has to a quality score. And notably, return on investment capital measures true economic profitability, as accounting earnings can be distorted by depreciation schedules, tax quirks, one-time charges, and revenue recognition choices. In contrast, ROIC strips these potential distortions away and illustrates how much profit a company actually generates for every dollar invested in the business, and is one of the clearest indications of long-term shareholder value. So keeping this in mind, chip makers, especially those with AI endeavors, are posting unusually high ROIC right now because they are in a rare moment where demand is exploding faster than capital needs. And with the often praiseworthy ROIC percentage being 20% or higher, it's noteworthy that NVIDIA's Zacks semiconductor general industry average is at an ultra impressive mark of 63%. Still, NVIDIA is in a league of its own with an extraordinary ROIC of 84%, as you can see right here. And these numbers place NVIDIA in the top percentile of all large publicly traded companies, especially among the mega caps. So NVIDIA's expansive invested capital base is just as mesmerizing as its invested capital base is edging towards $14 billion. And NVIDIA's invested capital is rising quickly as the company scales into one of the largest technology build-outs in history regarding AI, of course. So considering NVIDIA's high ROIC, this is generally a very good sign. And of course, invested capital grows when a company puts more money into the business through R&D, supply chain commitments, inventory, equipment, or long-term supplier prepayments. With R&D being research and development, of course. So whereas CapEx is the money spent in a given year on long-term assets, invested capital eventually includes these accumulated investments and represents the total amount of capital currently deployed in the business. And there you can see NVIDIA's very impressive invested capital base right there, ballooning to almost $14 billion. So showing how well NVIDIA is able to turn resources into cash after necessary reinvestment is its favorable free cash flow conversion rate. So free cash flow conversion evaluates how effectively a company converts its earnings into free cash flow, providing insight into management's discipline, investment efficiency, and the quality of a company's earnings. And while operating cash flow shows how much cash a company's core operations generate, free cash flow conversion reveals how effectively those accounting profits translate into real cash. So there's a couple of nuances here. So the often admirable level for free cash flow conversion rate can be 100% or higher, but the also preferred level can also be at least 80% or higher, with NVIDIA's at a respectable 81%. So when a company is generating more operating cash flow than net income, that's when you can see that free cash flow conversion rate be 100% or higher. But it's also noteworthy that an extremely high free cash flow conversion rate can also signal underinvestment. So right now, NVIDIA is definitely at a respectable 81% on this free cash flow conversion rate. So the conclusion and final thoughts here is that considering NVIDIA's extremely high ROIC expansive invested capital base, and its favorable free cash flow conversion, NVIDIA is certainly making an argument as perhaps the most capital efficient stock to invest in at the moment, and is one of the most capital efficient hardware companies ever. And NVIDIA is firing on all cylinders in terms of capital allocation, even outpacing software companies that would usually have higher ROIC because they require almost no physical capital. So it's no coincidence that NVIDIA stock currently sports a Zacks ranked #1 strong buy based on a positive trend of earnings estimate revisions, with over 55% EPS growth projected in fiscal year 26 and fiscal year 27. Again, I'm Shaun Pruitt, Zacks Equity Strategist. I hope you enjoyed this content. For more, please feel free to visit zacks.com/promo.